Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Parkamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for.
Excellent.
There's the disclaimer. I'm going to share my screen. As I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read them back to me. Another quick note is we are doing a webinar today with Interactive Brokers. It's at 2 p.m. Eastern. It will be on screening and interpreting multi-leg trades, option leg trades that are trading in the market, particular symbols. And that will be at 2 p.m., but you do have to register with Interactive Brokers. We're not going to be putting it out on YouTube like we usually do because Interactive Brokers is hosting that webinar.
I dropped that link into the YouTube chat, so anyone who wants to register for that, it's there for your use.
Yep. All right. Thanks, Will. So while we're waiting for questions, for you guys, give you a couple minutes to type in those questions, we'll start out taking a look at the pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. So pre-market report, these are stocks trading in pre-market hours. Up top, we have this calendar view. It allows you to go back in time if you wanted to and check out what happened in a pre-market on a historical date. Today, we are on January 9th. And so far, from a high level, this is what's going on. We have 314 stocks trading higher in the pre-market hours, 487 stocks trading lower. As far as volume goes, we have 87.6 million shares on up volume versus 208 million shares on down volume. And if we convert that volume to dollar value, we have $1.3 billion worth of stock trading higher, $2.7 billion worth of stock trading lower. So that indicates that the trading in a pre-market hours so far is trading with some bearish sentiment, a bearish lean towards the sell side. Let's continue down to the next part and to see if we could get what's going on from a couple different perspectives. Then we'll move on to the questions. And as I scroll down, you'll see a list of different stock symbols that are trading in the pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. And to make this list, we do set certain thresholds, liquidity thresholds, volume, price changes, and so forth, because things in the pre-market can be very liquid, and sometimes the volumes are very low. It could be just like one share that traded. So there are certain thresholds we set to make this list. But any security, if it's listed on a major U.S. exchange and meets those thresholds, it can make this list. So it could be a small cap stocks, an ETF, a leveraged products, closed-end fund, prefer anything that's traded on a major U.S. exchange. And to narrow down this list to a small group of stocks, to get some deeper insights, we could use the filters above. If you have a watch list, you could use a watch list. We're going to use this filter here in ETF in our example. You click on it, get a drop-down menu of different ETFs to choose from. We're going to pick this one, SPY, which is the S&P 500 ETF. And when you do that, the list below will get filtered by stocks that are holdings in the SPYTF, which are the S&P 500 constituents. And here, now we have our biggest percentage gainers and biggest percentage decliners side by side. So you see 3 stocks that met our thresholds for the biggest percentage gainers list. There are 20, though, that hit our thresholds on the biggest percentage decliners list. And again, from this perspective, it's also indicating that the activity in the pre-market hours, trading in the pre-market hours, has a bearish lean or bearish sentiment with a bias towards the sell side, right? So we gave it a couple minutes. I think I'll take the questions now.
Yeah, we had a question from Jackie. Jackie was asking, will everyone, there are percent win rate and probability of touch on the option screener's result tab. Can you ask Dimitri which one is more important when evaluating the option candidates?
Which screener is he looking at?
I'm assuming he's looking at, well, Jackie, you're on. Can you let us know which exact screener you're looking at? He says there is win rate and probability of touch. It says an option screener results.
So we have a lot of options screener to, if you give me a more specific one, I'll take a look at it. I'm not sure which one you're looking at. So, we have option screens, for many different things. We have them for different types of strategies, for volume, for so forth. So just let me know where you're looking at. This way I could at least, focus on that question and make sure I'm answering the correct question.
Perfect. We did have a question. I was looking at it from and Rob's on, so he could Jackie, there he is. Any option results screener, naked. He says naked put or long call.
So like a long call.
Yeah.
Okay. So when you say option screen, for example, here, I'm just over here, as you tab on, these are all different types of option screeners. These are all different types of option screen, and they're not all the same analytics. So when you look at a bull call spread, it's going to give you a completely different set of metrics and analytics because it's a bull call spread, which is different than a straddle or butterfly or nine condor. So you're looking at I believe a long call.
Correct.
Okay. So over here you're looking at these stats, the probability of touch. All right. So when we give it, well, first let me answer part of the question, because I think you're asking which one's more important, and I get these questions sometimes. Well, what's more important, edge or win rate? And these are metrics that give you an answer to a different question. So if one was important and one was not important, we would not list it. Like if it was just like, here's an important one and all these are meaningless, we wouldn't put it on here, okay? Because we don't want to just put things on there that are meaningless. It's giving you an answer to a different question. It doesn't have a particular one is more important than the other, because one answers one question, and a different metric answers a different question, so it's like saying, what, if I'm analyzing a stock, and you could say, well, what is more important, earnings or debt? Well, these are two different things, that you should be looking at in your overall, because I can't say earnings and then just ignore the debt, right? I can't, because if I say just focus on earnings and don't worry about the debt, well, that would be irresponsible. And if I told you, well, just look at the debt and don't look at the stock company's earnings, that would be irresponsible. So when we look at different metrics, think of it as they're trying to answer a different it's a different question. They're not both telling you the answer to the same question. They're answering two different questions. Okay. So when we look at these, what are these telling us, right? What is this metric, the win rate, and what is this metric, the probability of touch? What is the difference, right? Is a better question. What is the difference in them? And understanding the difference that will help you make a better, more informed decision. So in this particular analysis of a call, right? So in this screener, we perform some data analytics, so you have some benchmarks to reference, right? So when we're looking at a price, and then we have to come up with some benchmarks to try to assess the value of that option and compare it to the market price. Okay, that's what we're trying to do. And you could open up the analysis, over here, and you'll be able to kind of read about it, see the data that we're using. Okay, so that's where everything is in here. But let's go over these results. Okay, so up top, I'm just going to use this Apple one. We see that this particular option, January 19th, 190 strike call, the market price, if you bought it on the offer, because this is a long call, so we're evaluating the offer price, is 80 cents. And that's the market price. That's something everybody could observe. And it's just somebody who's willing to sell it at that price, right? And they post limit offer to sell. But then what we want to do is try to figure out, okay, what is a good value for that option, or what benchmark can I give it to know if this is very high, is it very low, is it reasonable? Like some way I need to evaluate it, because just by looking at market prices, I have no idea, right? It's like if you go and try to buy a house in a neighborhood, in a state, in a city, in a town that you've never been to, and and somebody just throws out a market price at you, well, you have no idea if nobody appraises it, if you don't have anything to compare it to, nothing, you have no idea if you're buying a house for 500,000 that might be worth 100,000, or you're buying a house for $1 million that might be worth 12 million. You don't know, right? You need to, and I'm giving you an extreme example. You go through appraisals, you go through comparisons and stuff like that. So when we look at market prices, that we start to try to use certain benchmarks to start making those assessments, right? In this example, and I want to say there's no one correct method that fits all, right? We can't say that either. There are different models that can produce different results, and every model also is subject to the data that you're inputting and the assumptions that you're making. All right, so these are estimates based on models. So when you get a house appraised, well, the person who appraises the house is using some kind of methodology, some kind of model, some kind of inputs, and some kind of assumptions, right? And he comes up with, but that doesn't mean the appraiser comes up with an exact price to the penny, and that means that is it's worth. That he's creating an estimate. And you could have 5 appraisers come up with different estimates as well. So in this particular estimate, what we're doing is saying, okay, we have this option. We know when this option is going to expire, right? January 19th. So we know how many days we have left of trading. we know the strike is 190, and we know where the stock is. So we know how much the stock needs to increase by in that time period for this option to be in the money. And we know the premium that we're paying. So we know we could add the premium to that strike price to have an exact percentage move from here, from 185.85 to 190.80 to break even. And we know above that would be profitable. And we know the payout at expiration. If the stock's below 190, this option will be worthless. If the stock's 192, it'll be $2 in the money. You paid 80 cents, so you made $1.20 in profits. So those are certain things we know, but we don't know the probabilities of all these things happening. Right? That there's no way of knowing that for sure, because it's not the same thing as if you take a piece of dice, for example. There are 6 numbers, so there's only 6 outcomes. And you could figure out, and if the outcomes are, the dice is fair dice, there's 1 in 6 chance of anyone coming out. You could figure out that probability. Here, it's not the same thing as a dice. There's no dice that you flip, and the stock will either be, 195 or 185. It doesn't work that way. It could be many different things, and there's no set of probabilities that we could go and apply. We have to estimate those probabilities, right? To create our values, we need to be able to do something to estimate those probabilities, or we cannot run a model, right? Without estimated probabilities or distribution or return, we won't be able to run the model, right? So to estimate the probabilities of the stock going up a certain percentage, down a certain percentage, staying the same in that time period, to calculate those probabilities, one method to do is we could reference historical data and use that historical data as our guidance, right? That the return distribution will look similar somewhat in the future to the past. Like that, obviously it's not going to be exact, right? There's no way to, and it could change, over time, but these are our benchmarks, our reference points, to try to get it close. How do we get to the close of what we think it may be going forward? So what we do is in this particular model, and you could change it, I think over here, you could change 4 years, but I'm going to keep it right now. It's set to 4 years. It looks at 4 years of data and says, okay, take 4 years of data in Apple. And if we run the return distribution for Apple, given this time frame, right? Given the same time frame we have from today to expiration, and then this model is actually taking other things into consideration. It cleans up and sets up the data that's more relevant to this situation. So what it will do is say, okay, well, if there are no earnings here between now and January 19th, go back in history, make sure I don't have data in my analysis that includes earnings, because we know that the stock will move differently, and so forth. So does that already in the background for you. Otherwise, you'd have to, take the data and do that yourself. It also makes it dynamic based on the current implied volatility environment. Okay. So then it takes that data and says, okay, based on that data, right, if I ran it for the last 4 years, assuming I ran it for the last 4 years, so sometimes the stock went up, sometimes it went down, sometimes it stayed the same. But if I ran that data for over 4-year period, on average, what would the end value be of this option if I applied those historical returns, right? And here it's $1. The average is $1.47. Doesn't mean every time it's $1.47. Sometimes it could have been $5 because the stock was up 10%, maybe. Sometimes it was, completely zero because it was unchanged or whatever. So looked at all those observations and said, okay, there's an average value. So now we have some benchmark to compare it to, right? Because if this was a penny, we'd be very suspicious. Well, why is this 80 cents? Something else must be going on, right? Why would? But now we have one benchmark to look at. We have an average value of $1.47. So is 80 cents based on these two numbers? 80 cents doesn't seem unreasonable, right? That like so far it doesn't seem unreasonable. So that's one. So and this theoretical edge is just telling you that the difference between the two divided by the market value. But we also know that if we're taking an average, right? If you're taking an average, that doesn't mean that every time it's $1.47, and it also doesn't mean that that sometimes it's $1 and sometimes it's $2. Half the time it's $1, for example, or half it's $2. It doesn't mean that, because there could have been data points in there that it ended up being $10, $12, and then a lot of them were zero, right? So the average gets skewed based on that, right? So if you had 10 times that it was zero, and and 1 out of 10, let's say it was $10, it looks like the average is $1 or whatever. But we know that doesn't mean that half the time it's zero, half it's two. So could have been some outliers or so forth that made that average skew. So what do we want to know next is, well, how often, based on those observations, right? Based on all the observations that we saw, right? So if we open this up, and we see there, 4 years of data, we had 54 observations. Remember, we're cleaning some of those out if they had earnings or something else. So we had 54 observations, right? That you could see here from October, here, December 12th, December 22nd. So you could see here, 54 observations. Okay, and these were the returns. So if we looked at those observations, what we want to know is, well, how many times, because for our case, and what is desirable, that the stock moved enough, how often did it move enough that it would have covered this 80 cents? In other words, by big enough percentage from 185.58, that January 19th, it would move above 190.80 cents, right? That's how frequently did it do that? Did it do it like one time where it was a really big move? Did it do it half the times? Did it do it 90% of times? How often does it tend to do that? And that's what this win rate is, because if it does it 100% of the time, that means, well, 100% of the time it always just tends to go up that much. But we know, that's not what Apple does. So this win rate is saying that out of all our observations that we looked at in the last 4 years, 27.8% of the time, the stock historically went up by a big enough percentage that it it covered by expiration. It went above the 190. It would have gone above this, plus covered the cost of this premium to be profitable at expiration. Okay, that's what it's saying. That's the historical win rate at expiration. How many times did it do that? So now we got two benchmarks, right? That the average end value to compare to the market price. And then we got the percentage of the time in our historical data that it was profitable, it covered the cost of that premium. Okay. And like, think of it as a wheel. If you were playing, if you're picking a number from 1 to 10, you might win and you hit 10% of the time. But if the payoff is great for that one, then you might have a big positive return, but not a lot of frequency of wins. So what is the probability then of touch? So now we have another metric here, right? So what the probability of touch is saying the following: that between now and January 19th, right? Between now and January 19th, let me see something. We have 8 trading days, right? So the historical data is saying that over 8 trading days, how often, how much did it move? Because we know that, a stock, in 1 minute cannot move by the same percentage as it can in a week or 2 weeks or a month. Like a stock in 1 year maybe could move 30%, but in 1 minute it's not going to move 30%. And in 1 week it might not move 30%, but it might move 5%. So this is looking at an 8-day stretch time frame. So there had to be 8 days that traded for us to calculate that return, right? But we also know that within 8 days the stock could be volatile. So it's not like if we looked at the price today and 8 days from now, well, the stock could be unchanged, but that doesn't mean it didn't go up or down between those 8 days, right? It's not like between now and in 8 days from now, it's going to be at the highest level of the 8 days or the lowest level, right? It just 8 days went by, but it is moving around in between those 8 days, right? So it could have gone up 10% in that day. Day 4 could have been up 10%. Day 8, it could have come back down to unchanged from the starting point, right? It could start at 100 and end at 100, but it could have in between gone to 110. It could have gone to 95 and then ended back at even. So it's still moving around. So then what we want to do is look, well, what happens in between, right? Now we kind of got our analytics from, start to finish over an 8-day time frame. Now what happens in between? So in between that time period, right? Maybe if we just looked at any point in between, did the stock go high enough to cover that, right? Like maybe day 3 or 4 or 5, 6, right? It has a lot of days in there that it could have still made that whatever, couple percentage move that it needs to make. So that's what this is. It's saying, okay, over an 8-day stretch, if we looked at an 8-day stretch, that 27.8% of the time, it would historical data showed it covered it and it was profitable. If we looked in between those 8 days, like if we looked at, the highest lowest points, how often did at any point between between those 8 days. At any point, doesn't matter if it was day 2, 3, 4, 5, did the stock go up enough to cover the cost of, this strike and this call? And that's what this is, the 46.3%. That 46.3% of the time in our observations at any point, in that 8-day period, the stock reached a high enough point to cover that.
So awesome job, Dima.
Yep.
Opening bell just rang. Great
All
job.
right, guys. Thanks everyone for joining. Stay safe out there. Hope to see you guys later this afternoon. 2 p.m. Eastern. We're doing that webinar with Interactive Brokers. Hopefully that answered the question and it was helpful. And yeah.
Yep. And I put the link in the chat. We did have another question from a new June Wong, and I'll send that over to you. Maybe we can get that tomorrow. Awesome job, buddy.
All right. Thanks, everyone. Hope to see